Let's talk about Marushika Technology. It has a story that, honestly, looks incredible on the surface. We're talking explosive growth, soaring profits, the whole deal. But if you pull back the curtain just a little bit, you find this web of risks that could, well, unravel the whole thing. So in this explainer, we're going to unpack both sides of this high-stakes story.
You know, skyrocketing revenue always grabs the headlines, doesn't it? But is that really the whole picture? In this explainer, we're going to look past those impressive growth charts to find out what's really driving this company, and maybe more importantly, what could bring it all crashing down.
So, first things first, who exactly is Marushika Technology? They operate in a really critical, but often kind of unseen part of our digital world.
Okay, so think of them as a key supplier for the digital backbone of other organizations. They're the ones providing and maintaining pretty much everything from data center hardware and cybersecurity to surveillance systems for both big companies and government clients. On paper, they look pretty diversified. You've got the core IT and telecom stuff, right? Then they're pushing into modern smart solutions like automated parking systems, and they've even expanded into high-tech maintenance for military vehicles. I mean, it's a pretty ambitious scope. And all that ambition seems to be paying off, at least when you look at the top line. The company's financial performance shows a truly powerful upward trend. Let's see just how powerful we're talking about. Okay, let's set our baseline. In fiscal year 2023, the company brought in just under 37 crore in revenue. A solid number, you know, a good place to build from, but nothing that would necessarily make you stop in your tracks. But then, look at this jump. Just 1 year later, revenue soared past 60 crore. That is a huge increase. It signals some serious momentum, and clearly, massive demand for what they're offering. Okay, now things are starting to get interesting. And the acceleration just keeps going. In fiscal year 2025, they hit over 85 crore. So, in just 2 years, they've more than doubled their revenue. Now that is the kind of explosive growth that gets everyone's attention. Now here's what's really interesting. This isn't just growth for the sake of growth. They are profitable. Their profit after tax, or PAT, has just climbed dramatically, right? From just 40 lakhs in FY23 to over 6 crores in FY25. So they're not just selling more, they're actually making more money on what they sell. Okay, so where is all this fantastic growth actually coming from? Remember those 3 business verticals we saw a minute ago? Well, the way the revenue is actually distributed might surprise you.
And this slide, wow. It reveals the reality of their business. Despite having 3 divisions, the company is almost entirely dependent on just one, IT and telecom infrastructure. The other 2 verticals, combined, make up less than 3% of revenue. So in practice, this really isn't a diversified company. It's an IT infrastructure company, plain and simple.
So what we have is a fast-growing, profitable IT infrastructure company. The story seems pretty great so far, right? But this is where we really need to look closer, because beneath that impressive surface, there are some pretty significant structural risks. Let's just start with a direct quote from the company's own filings. This isn't speculation or a rumor, this is a stated fact from them. Ongoing legal proceedings, including criminal and tax cases, are hanging over the company and its leadership. And that's a major red flag for stability.
All right, now let's talk about a concept called concentration risk. It's basically a fancy way of saying you have way too many eggs in one basket. First up, nearly 80% of their revenue comes from government-backed projects. Now, this can be great when things are good, but it makes the company highly vulnerable to any shifts in policy, budget cuts, or project delays.
And that concentration risk doesn't stop there. Geographically, over 40% of their entire business is located in one single state, Delhi. So any local economic downturn or political instability right there could have a massive, outsized impact on the company's bottom line. And it gets even more granular. A full quarter, 25% of all their revenue, comes from a single customer. Just one. So if that one client decides to switch vendors or renegotiate terms or simply cuts their budget, Marushika could lose a quarter of its business overnight. And this dependency, it exists on the supply side too. Almost a third of all their product purchases come from one single supplier. Any disruption with that one partner, whether it's a price hike or a delivery issue, could literally cripple their ability to operate.
And finally, let's look at the financials beyond just that big profit number. In FY24, they had negative cash flow from their core operations. This is a really worrying sign because it means more cash was going out than was coming in from their main business, even if they were reporting a profit on paper. Add to that, they're owed nearly 40 crore by customers, they're carrying almost 19 crore in debt, and have over 6 crore in potential future liabilities. You gotta remember, profit is an accounting concept, but cash is what keeps the lights on.
So, we have 2 very different stories here, don't we? One is a story of incredible growth and profitability, and the other is a story of extreme dependency and potential instability. How do we even begin to balance these 2?
With a crucial point is this stark contrast. On one side, you've got all the markers of a breakout success, rapid growth, strong profits, experience in key government sectors. But on the other side, you have a foundation that's built on extreme concentration, questionable cash flow, high debt, and some very serious legal issues.
And this all leaves us with the ultimate question. The promise is clear, it's obvious, but the perils are just as vivid. So when you weigh that incredible upward trajectory against all the cracks in the foundation, you just have to ask yourself, is the potential reward here truly worth the documented risk?